AQN has been one of the best performing utility stocks to own over the past decade. Including dividends, AQN has more than doubled the returns of the S&P 500, with returns of over 500% from 2009 to 2020 versus the SPY's 241%. However, the stock has been absolutely crashing over the past year, and now it is down over 50% from its all-time highs, with the most recent crash coming after the company reported its third quarter earnings. This drop has also caused the dividend yield to absolutely skyrocket to over 9%, and now it is leaving investors with the question of if AQN is a stock to buy now, or if we should all be avoiding it. In this video, we are going to go over AQN's earnings and dive into why the stock is crashing, and answer the question of if this is an opportunity, and I'll also update you with everything you need to know about AQN. So with that being said, let's just dive into the video. And like always, I have screenshots that I want to share with you from all of the research that I did. So right away, this says, Algonquin said it's earned 11 cents per share in its latest quarter on an adjusted basis, compared with an adjusted profit of 15 cents per share in the third quarter of 2021. So earnings per share have declined by about 20% year over year, and immediately this is why the stock is tanking, because earnings are dropping on a per share basis quite dramatically. Continuing on, this says, looking ahead into 2023, broadly speaking, we expect pressure from increasing interest rates and broader economic conditions to impact our earnings. In light of the changing environment, we are reviewing our plans and targets for 2023 and beyond. So basically what I get from this paragraph right here, this quote right here, is that the company is no longer sure in its 2023 guidance, and with interest rates rising, the company is seeing a lot of headwinds, and we're going to find out why here in a minute. So then it continues on, Algonquin lowered its expected earnings per share for fiscal 22 on Friday from between 72 and 77 cents to a range of 66 to 69 cents. So even for the full year of 2022, they lowered their earnings guidance, and quite dramatically as well. This is a drop of about 10 to 15% in their 2022 guidance for the year. So the fourth quarter of 2022 looks like it's going to be another pretty bad quarter for AQN. Reported an earnings drop of about 20% year over year. Now they're saying that 2023 looks uncertain, and then they're also lowering their guidance for 2022. This is like a triple whammy of negative news for AQN, and that's why the stock is dropping so freaking dramatically. Then at the bottom of the screenshot here, it says, the capital-intensive nature of the business leaves it acutely exposed to higher interest rates and capital market volatility. So right there, this is why the higher interest rates are a serious threat to AQN's business, is because it is such a capital-intensive business. So if interest rates are rising, then they're going to have to continue paying more and more interest on their debt, essentially. So now let's move on to the second screenshot, and this comes from the earnings as well, and it says, Algonquin hopes to close a $2.6 billion deal to acquire the Kentucky Power Company and AEP Kentucky Transmission Company in January. At the same time, it entered into an agreement last month to sell its stake in a portfolio of wind assets in Canada and the US to a UK investment firm. I mean, think about this. The company is saying, higher interest rates are going to be a problem for them over the next year, essentially, or over the next 18 months. But on top of that, they're still like, you know what, even though interest rates is going to be a problem because we have so much debt, we're still going to acquire a $2.6 billion company in the United States, and we're going to do that in January. I don't know. It doesn't look like, to me at least, that the company is slowing down. They're still taking on debt because they're not going to be able to afford this acquisition in cash that they have right now. So they're going to have to finance this. So they're acknowledging that interest rates are a problem, and then they're continuing to take on more debt. So in my opinion, it doesn't really look to me like they're actually dealing with the problem or trying to solve the problem at all. All right, now the next screenshots that I have come from the company's transcript that they just reported, or the company's transcript that for their Q3 earnings. And I took screenshots from my phone here, and this screenshot right here says, while increasing interest rates is a market-wide phenomenon, the impacts are different from company to company. As a capital-intensive, growth-oriented company, Algonquin faces headwinds from higher interest rates and capital market volatility. We recognize these challenges and are committed to identifying and implementing adjustments to reduce our reliance on raising equity and to moderate the impact of rising interest rates. So basically, the company is saying that, again, with rising interest rates, raising debt is going to be more of a problem. And with the equity markets this year, with the stocks being down and with their stock now being down 50% from its all-time highs, it means that they're not going to be able to raise as much money nearly as easily. So the dilution that the company was doing historically to fuel growth is now going to be or going to have a much larger impact on its shareholders. So now let's move on to the next screenshot right here. Again, this is from the transcript, and this says, at the end of Q3, approximately 22% of our consolidated debt outstanding was subject to variable interest rates. So almost a quarter of the company's debt is subject to volatility in interest rates. It's not on fixed rate loans. So if interest rates are rising, then 22% of their debt is going to cause, higher interest payments for the company. And then this says a 100 basis point increase in the variable interest rate would impact interest expense by approximately 16% annually. So if interest rates rise by 1%, then the company is going to have an additional $16 million of interest expense that's going to immediately come from the company's profitability and cash flow. And I mean, how much have interest rates risen this year? How much are they going to rise in the future? That's really something to pay attention to. Then at the bottom here says, from a financing perspective, we have several near-term facilities and approximately $100 million of long-term debt maturing throughout 2023. So this is also a problem because if the company has debt right now, right, at a low interest rate, and that debt is going to mature and then they need to refinance that debt while interest rates are higher, then the debt that they have low interest rates on right now are going to become a bigger burden for the company because they're going to have higher interest rates on that debt when they refinance it. So I went and I took a look through AQ1's actual debt right here, and we can see that they have this commercial paper debt expiring in 2023, which is about $445 million. And then they have senior unsecured notes right here with an interest rate of only 1.18%, which is retiring in 2026, which has a value of $1.15 billion. So even by 2026, if interest rates are above, 1.18%, then this is a large amount of debt that's going to become a problem as well. So they have debt that is maturing over the next year at low interest rates, and when that debt matures, their interest payments on that debt is only going to increase. Now, let's go back to the transcript of the earnings call, because this guy right here, Nelson Ning, this is an analyst from RBC Capital Markets, and they asked a fantastic question. So check this out. Okay, thanks. And the second question, in terms of your liquidity position, you flagged that you have about $2.1 billion of available liquidity. Will most of that be allocated towards the closing of the Kentucky Power acquisition? I think that's about $1.4 billion. Is that right? So remember the acquisition that AQN is doing in January and they're still going through with. This analyst is basically asking, okay, well, you guys said you have $2.1 billion of available liquidity. So is that going to be going to this acquisition? Now, the next screenshot here is basically the reply, and this says, yes, so we would expect the proceeds of our sell downs to have liquidity probability in the range of $2.5 billion as we exit the year. And yes, we would look to use those credit facilities to fund the transaction as well. So the company is confirming that they are going to be taking on additional debt to fund this acquisition that they plan on closing in January, and it is a massive acquisition. Then down here it says, you flagged that 22% is subject to floating, but obviously when you draw to the close of the Kentucky Power deal, I guess all of that would be subject to floating as well. So he's basically asking, is this, $1.4 billion of additional debt that you're taking on, is that going to be subject to variable rates and floating rates as well? So is it going to be subject to rising interest rates? And then the CFO's response is clearly yes. So that additional large amount of debt that AQ1 is taking on is going to be subject to floating interest rates. So if interest rates go up, it's going to harm the business as well. And then the CFO says, which is part of the reason that we've given the color on next year with the pressure that the interest rate is causing. So that's what I mean, is why is the company still going through with this acquisition then? Then I went and I took a look at AQ1's income statement, because right here we can actually see that the revenue grew by like 22% year over year to $666.7 million from $529 million last year. So the revenue for this business is growing strong. And I think that AQ1 is another clear example of what we always say here on the channel, where revenue growth is not the holy grail of investing. If it was, then AQ1 would be hitting all-time highs right now. But there's more to investing than just buying businesses and buying stocks where the revenue is growing. They also have to be growing their profitability, and they have to be creating value for shareholders. If revenue is growing, but they're not creating value for shareholders, then the revenue growth is meaningless. And again, AQN is a perfect example of that because the stock is absolutely crashing. Now, if we go down further on the income statement, we can see that the interest expense for this business in the third quarter has increased by 50% year over year from $51.6 million last year to $75 million this year. So the interest expense that this company is paying, or the interest on their debt, is absolutely skyrocketing. It's literally up 50% year over year. And the result of this is the company is continuing to take on more debt, and they're going to just continue acquiring businesses, it sounds like, and lowering their profitability and putting the company at a larger risk of, interest payments. So now what we're going to do is head over to Stock Unlock. We're taking a look at AQN right now. We're going to head over to their financials. We're going to head over to the cash flow statement and take a look at their debt repayments on a quarterly basis, because right here back in 2016, they took on $1.4 billion of debt. Then they took on $771 million. And you can see that every time that this number is positive, it's the company taking on debt. Right here in the first quarter of 2021, $776 million of debt. Right here in the third quarter, another $392 million. Then in the first quarter this year, $935 million. You get the point. This company takes on a lot of freaking debt, and it's consistently taking on debt. It's just like maybe once a year the company spends, maybe $100 to $300 million paying back debt, but then the rest of the year they're taking on billions of dollars of debt. And that's how this company is really financing itself and financing its growth. Now, also another thing that's important to pay attention to here on the cash flow statement, since this is a dividend paying company, is let's take a look at the cash from operating activities, okay, of about $733 million right here. Now let's scroll down to the dividends paid of $362 million in the trailing 12 months. So let's pull out our calculator. We can go 736. We're going to round up, or 733. We're going to round up and be nice to the company. And then we're going to subtract the dividends paid, which was $363 million in the past year. And this means that the company's operating cash flow, so the amount of cash that it actually generates from its operations, minus the dividend payments, leaves the company with $370 million of cash left to invest in CapEx, or to spend money on CapEx, or to spend money on growth. That's all the money that the company has left organically. Now, if we take a look at the investments in property, plant, and equipment right here, it was negative $1.35 billion in the past year. So let's subtract $1.35 billion from the cash that they have left over after paying dividends. And this means that the company has negative $1 billion. So with the company's CapEx right now and with the dividend, it's not producing nearly enough money at all, not even close, okay? So then the question for me becomes, where are they getting the extra money from? Because they can't just be burning $1 billion every single year like this. So where is the money coming from? Then right here, we can see that it comes from debt repayments or debt raising of $783 million. So let's add $783 million of debt. And then they still have that negative $197 million that they got to come up with. So where does that money come from? Well, we can see right here that they do net common stock issued, which is dilution. And in the trailing 12 months, they have done $719 million of dilution, which is how the company is affording to fund itself. Basically, what I'm trying to say here is that AQN is taking on a lot of debt and diluting their shareholders to fuel this growth that the business is seeing. Because as we saw, the company's revenue is growing, right? And if we go over to the income statement, we can see here that the revenue has been growing very, very nicely, actually. I mean, back in 2010, the revenue was $175 million a year. Now it's $2.5 billion. So they've like almost 15x revenue over the past decade. So very strong revenue growth, right? Well, now let's go over to the metrics here and let's take a look at the revenue per share, which factors in the dilution. And we can see right here that in 2014, the company had revenue per share of $3.81. And right now it's sitting at $3.68. This is what I mean. Revenue growth is not the holy grail of investing. And when you take a look at the actual per share revenue that this business generates, it's down over the past, 9 years now. So in terms of per share metrics, the company actually hasn't created any more revenue per share or any more value per share for its shareholders over the past 9 years because it's doing so much dang dilution. I mean, take a look at this. Let's go back over to the income statement. Let's take a look at their shares outstanding. And it's just been growing so much. I mean, back here in 2011, they had 113 million shares. Now they have 675 million. So they have 6x shares over the past decade, essentially. And that destroys shareholder value, or it takes away from shareholder value. Now, what we're going to do is head over to our freeform tool here, and we're actually going to take a look at the shares outstanding growth rate in terms of compounded annual growth since 2011. And right here, we can see that the compounded annual growth rate is about 18.54%. So they dilute shareholders by about 18.5% every single year. And it doesn't look like this is stopping anytime soon, and they're continuing to dilute. Now, what we can also do is take a look at the dividends paid versus the operating cash flow. And you can see right here that the operating cash flow is the light blue line. And historically, the operating cash flow has covered the dividend. So the organic operating cash flow covers the dividend. But then again, when we take a look at CapEx here, let's get rid of the dividend. we can see that the CapEx historically has been much higher than the operating cash flow, which means that the company is financing itself through debt and through dilution to essentially deal with this. Now, if we take a look at the company's net stock issued, which is essentially the dilution the company does on a quarterly basis, all of these spikes right here are the company doing dilution, and we can see that the spikes are getting bigger and they're getting more frequent, and this is just taking away shareholder value. Now, once again, we can take a look here at the revenue per share on the freeform tool, and you guys can see that this is kind of the trend. It's kind of just been topping out since 2013. And lastly, let's take a look at the operating cash flow per share. So how much actual cash flow does the company generate on a per share basis? And it's topped out here at 2019. And it's basically not really grown since 2016. If we actually go to 2016, the compounded annual growth rate is about 3% if we want to round up. So on the profitability on a per share basis is hardly growing as well. Now, the last thing that I want to do here is simply just show you guys the price to EBITDA for this business, because EBITDA seems to be the most consistent metric for Algonquin. And we're going to compare this now to Fortis, which is another utility provider, and they're one of the best utility providers in Canada. And then we're going to take a look at Capital Power, and then we're also going to take a look at Canadian Utilities. These are all other utility companies, and we're going to take a look over the past about decade. And really what we can see right here is that Algonquin's price to EBITDA was all the way up at about 14.5, and these other companies were trading for 4, 5, and 6. So Algonquin was essentially 3 times as expensive as these other companies on average, and it's historically been a very expensive stock in terms of price to EBITDA, because this is a utility company and it's not really growing that quickly. Now also, when we take a look now, if we just zoom in, we can see that Algonquin's price to EBITDA is coming down to about 6.9, but it is still higher than these other utility companies. This is what I think is happening. I honestly think Algonquin got super expensive because for some reason the market over the past couple of years was focused on revenue growth. If you had revenue growth, boom, the market loved you. We're going to price you as a higher stock. Now the market is going back to what actually matters, which is profitability and cash flow. And now that this is happening, I think that Algonquin's prices, its price ratios, are coming back down to reality and coming back down to what these other companies, these other utility companies like to trade for, which is a price to EBITDA anywhere from 4.5 to 6. But then again, you got to think about Algonquin has so much debt, it's taking on more debt, its interest payments are going up. A lot of its debt is on non-fixed rates or on variable rates, which is going to harm the company going forward. And it's going to take away from operating cash flow and future profitability. So basically, to me, I have some notes here, and I think AQN seems like a company that has been focused solely on net revenue growth, not even per share revenue growth, but just growing the overall revenue for the company over everything, over profits, over generating shareholder value, over everything. They're diluting shareholders, they're taking on massive debts just to grow revenue, and it's not actually producing revenue per share growth, which is what the market loved, as I said. But when you look at the actual value created for shareholders on a per share basis, it is hardly any. So over the past decade, really, this company hasn't actually created that much shareholder value when you take a look at the actual fundamentals of the business. And that is why the stock is absolutely collapsing now. It's all the way back down to $7.88. And if we take a look throughout history, the last time the stock was at $7.88 was all the way back here in 2016. So it's now lost 6 years of gains because over this time, in my opinion, the market was focused on the wrong thing, which was just revenue growth. Now the market is focused back on actual fundamental profitability and creating shareholder value. And since that is happening, and since we're seeing the shift in the market to what actually matters again, this stock is just losing significantly. It's losing a lot, and it's lost 6 years of gains. Personally, I don't like this stock. I've never liked this stock. I've always thought that its dilution and its debt was a problem. That's why I've never invested in it and chosen other utility companies over AQN. So for me, I'm not really interested in the stock now. I would personally be avoiding it. I still think that it's expensive. Those are my reasons why. I just think that this company grows through the wrong avenues. It doesn't grow organically. It just dilutes and takes on too much debt, and that's a problem in this environment, especially when the stock is now down like 60% from its all-time highs. It's going to have a serious problem trying to dilute and raise money now, and it's going to be hard to continue growing at those growth rates that it saw historically. So that's my opinion on AQN. If you liked the video, please remember to leave a like on it. If you're new here and you want to see more content like this, then please consider subscribing to the channel. We do our best to do deep dives like this on all the stocks, and this one was actually recommended by our audience. So if you want to see more stock analysis like this on a stock that you want to see, then leave a comment down below and let us know. And also, if you're interested in the stock analysis platform that we're building here, This is Stock Unlock, and you can go and get a 14-day free trial at our website, stockunlock.com, and it's risk-free. You do not need a credit card. All you need to do is enter in your email. And I can guarantee you that if you use Stock Unlock over those 14 days, that 14-day free trial, you will become a better investor and you will improve your investing. It's an incredible platform. So seriously, go and check it out. Get your 14-day risk-free free trial and let us know what you think about the platform. And please make sure to like the video and subscribe to the channel. But with all that being said, thank you guys so much for watching. I truly do appreciate it. And I really hope to see you all again in our next video.